Alright, boys. Here's how I identify high time frame draws on liquidity that allows me to base my bias and take good entries off of. I know someone in my YouTube comment section said this shit, so really time to help y'all. So first thing I go. Matter of fact, we'll just do this market replay on this little day. These longs that I did end up losing a little bit off of, but as you can see, my overall bias was right. I just, yeah, this wasn't the trade that I took. I took shorts here, but this was a market recap from yesterday, and I identified these highs that I wanted to see get taken out on the high time frame, right? So first things first, I go on the 15-minute time frame. I find the session high right here. Our session high towards the upside is the London high. Our session high towards the downside is the London low and the Asia low. For reference, this is the trade that I ended up taking yesterday. It wasn't this trade. That was a mock trade. The actual trade that I ended up taking was, I do believe it was this right here. And I put it, I want to say it was something like this. It was like that. And that was a trade that I ended up taking, which my bias was right. My stop loss placement was a little wonky due to news that came out at 9 a.m. But I did identify these high time frame lows that I wanted to get taken out. So if we go on the 15-minute time frame market open, I look at the Asia low, right? So first things first, I set up 3 lines. This is our Asia market open, which is at 19 o'clock where I am, CST, 7 p.m. Our London session, which is at 2 a.m. and our New York session, which is at 8:30 a.m. CST, I live in Texas, so that's those time frames for me. So first, we can see this high time frame draw on liquidity, session low, London low. This Asia low, which is a predominant low, and this 1 hour low. And even further towards the downside, we have this 1 hour low, this 1 hour low, this 1 hour low. So rather than being fully bearish for the day, I want to see these lows get taken out, sort of like this, before we can get a reaction to the upside to take out high time frame highs, right? And how I identify on the 15-minute, this is a session low, which is a prominent low, which is a good draw on liquidity that I want to see get taken out. As you can see in the market, we have a structure like this, which is sort of going up and down, up and down, up and down. But when we form these lows, especially with longer wicks, these are become our draws on liquidity that we want to see get swept out and see a reaction taking off of them, right? And then I move over to the 1 hour, right? We have this 1 hour low. Look at this low compared to lows like this or like lows like this. These are very prominent lows that are attainable for us. These are 500 to 600 ticks from market open that could perhaps get taken out, and we could see a reaction towards the upside off of them. So we have this 1 hour low right here, this 1 hour low right here. You could sort of see what I'm trying to say, right? And what is a low? A low is a down candle and an up candle, right? So for example, this right here would not be a low because it's a down candle, then another down candle. Regardless of the low that you see, it has to be a down candle, then an up candle, right? So this is a down candle, this is an up candle, this is a down candle, this is an up candle. So there are these 1 hour lows that I see sort of prominent. And then towards the upside, if we go, we could see this right here, right? This 1 hour low, which did not end up get taken out. And we could see on the 15-minute time frame, I'm sure that there are definitely some lows that we made off of this downtrend. This is a very prominent low that I want to see get taken out, which we ended up sweeping and immediately getting a reaction off of, right? And then if we go on the 5-minute, maybe there's a 5-minute high that I want to see get taken out of, right? So how do I base this off a trade? Now we have this 1 hour high, this 15-minute high that I want to see get taken out. And then towards the downside, we have all these lows. So I wait for a liquidity sweep, which we got right here with a sweep into this 15-minute bearish value gap with a low reaction, right? And then I wait for a 1-minute break of structure. Boom. Bonk. Make the down candle. We filled in this gap right here, and we ended up wicking into it and getting a reaction, right? So I think I really entered like around here for a 1 to 1.9. Stops all of this 1-minute high. If I really wanted to be safe, which probably what I should have done, I should have let my nuts hang a little bit and put it on this 1-minute high. and we get a perfect entry into these lows, which ends up getting swept through and hitting our take profit. And then immediately we could see we hit this draw on liquidity, this Asia low, this huge draw on liquidity, a session low, and we immediately start to get a reaction to out of it. We have prominent liquidity right here. We have this session liquidity right here that I want to see get taken out. So what do I do off of that? We get sweeps into this high levels of liquidity, London low, 1 hour low, Asia low off of one candle with a fill into this 15-minute bullish value gap with reactions. We end up inversing this 1 minute gap. To me, we didn't really get a break of structure, but I could see in my eyes that we're long-term bullish. Boom, enter right here, stop below this 1 minute for value gap, take profit at this London high for a 400 take dub. I didn't take this because I have a rule, one trade loss, I'm off for the day. I don't like anything more than that, anything less than that. I take one trade a day regardless of whatever happens. But this was a very, very good trade. As you can see, this right here is such a prominent high. We're on an overall downtrend, but this is the high that started this downtrend. So I really, really want to see this get taken out. And that's idealistically what happened. It always plays out. The draws and liquidity always play out. Now, there are more factors you could use, like order flow. You could use break of structures. You could use support and resistance to back yourself up. But in my eyes, these are all prominent highs. Now, yes, you don't really have a lot of this. You can see we have draws and liquidity over here. You can see we have this high that started this downtrend up here, which do end up getting taken out, although I don't trade ES at all. I only trade NASDAQ. I let my nuts hang a little bit. ES is a little bit too slow of a price action. But you could see at the same time, we take high time frame lows out with this London low and this 1 hour low over here. We ended up getting a reaction out of it. We inversed this entire row of fair value gaps, right? So if you did want to take a trade on ES, boom, boom, maybe below this gap for right here. You could have even run it up here. All of that would have came and taken out because the market is based on draws and liquidity. Institutions want to fill in these draws and liquidity, and they use these draws and liquidity for their advantage to see retail traders like us get our stop loss taken out, right? Okay, for example, let's say, how do I look at this from a retail perspective, right? Or an institutional perspective? For them, when they see these draws on liquidity get taken out, these are areas of rejection, right? But the average retail trader sees the random downtrend, so they probably tend to enter shorts right here. And when market takes out this liquidity, it completely goes the other way, which in turn stops them out and brings money back to the markets, right? How we can use this to our advantage is we know that the market makers want to see liquidity get taken out. So we use that for our advantage and we wait for reactions off of these draws on liquidity. Not only am I using these to target, now let's say suppose that high time frame I wanted to see this London high get taken out, which in fact does, right? We end up taking out high time frame draws on liquidity towards the downside, signaling a reaction. We get inversions to the upside, which means that we can conclude that the market's going to be bullish for a little bit and could take out these high time frame draws and liquidity. Again, I'm not the best teacher. I'm not really good at like teaching stuff like this rather than the fact that just explaining my thought process. But that's like my thought process whenever I see the market. I see this happens towards the upside and the downside, right? I see the market takes out a good draw on liquidity towards the downside and we get a reaction and a rejection off of it. So I know that most people would have probably taken shorts here and gotten stopped out towards the upside. But if we think in an institutional perspective of point, when we're taking out this high time frame draw on liquidity and getting a reaction off it, I can deduct that we're going to go towards the upside. I don't know if that makes sense or if it sounds like I'm using a lot of buzzwords or something like that, but that genuinely is my thought process. If you look at all my trades, most of my trades are targeting a high time frame draw on liquidity based off of a medium to high time frame sweep of liquidity and a reaction off of it. Liquidity sweeps are the most important thing. Every trade that I take, you'll see at least a 5-minute or 15-minute lower high get taken out, maybe even a session high, right? I always take a trade. The first thing that I look for to take a trade is a high time frame sweep, whether it be 15-minute, 5-minute, or London high. I never really take it off a 1-minute high unless it's market open. If I'm waiting for a trade, it has to hit a high time frame draw on liquidity and get a reaction out of it. That's really it. I appreciate y'all. Y'all boys have a great one.